Here's what nobody tells you about retiring with $2 million in your late 50s. The number means nothing if your taxes, investments, and withdrawals aren't working together. After analyzing hundreds of retirement cases and working with clients who accumulated $2 million by age 57, I've learned something critical. Hitting that number does not guarantee success. In fact, it can create a false sense of security. In this video, I'm sharing the exact framework you can copy to turn $2 million at 57 and beyond into lasting income, lower taxes, and real retirement freedom. Let me introduce you to Mark and Patty. Both are 57 with about $2 million saved for retirement. On paper, they did everything right. But here's what's keeping them up at night. They didn't just want to retire. They wanted to retire and maintain their current lifestyle. In other words, the question wasn't, can we survive? It was, can we retire on our terms? And maybe you can relate. You've done the hard work, you've built a solid nest egg, but now you're asking, is this truly enough to fund my desired retirement? Or do I need to keep working? But here's the thing. The number itself only tells half the story because it's not the size of your portfolio that creates freedom. It's how you structure it for retirement. And for Mark and Patty, their structure revealed something surprising, something that would completely change how they thought about retirement readiness. When I first dug into their plan, I wanted to see how their $2 million was actually divided. And that's when things got interesting. They had about $1.2 million in pre-tax 401ks, $500,000 in a taxable brokerage account, $250,000 in Roth IRAs, and $50,000 in cash. And this is where Mark and Patty had made one of their smartest moves, one that most retirees overlook. They didn't just save a lot, they saved strategically. They built tax diversity. Instead of piling everything into a 401k, they built 3 separate tax buckets: pre-tax, after-tax, and tax-free. That one decision gave them flexibility to retire on their terms without being boxed in by tax penalties or pushed into higher tax brackets. It's an extra layer of control that can completely change how retirement income works. But even with this smart foundation, Mark and Patty were about to make a costly mistake. When we started discussing their portfolio, Mark and Patty were confident they had the perfect plan for generating income. They were convinced that high-yield investments would be the key to replacing their paychecks. Dividend stocks, closed-end funds, high-yield bonds, anything that paid income without touching the principal. It's a common belief, but a dangerous one. You see, while high-yield strategies often promise stability and income, they hide major risks like illiquidity, leverage, and steep drawdowns when the market drops. Take one example, a 4-star global bond fund that claims to provide high income potential through a diversified mix of global bonds. Sounds ideal, right? But in 2022, when the stock market dropped 22%, this fund lost 27% of its value. And this behavior isn't uncommon. Since 1983, high-yield bonds have remained highly correlated with U.S. stocks and have produced negative returns in all 9 major stock market sell-offs. Dividend stocks aren't the solution either. In fact, of the 17 dividend funds that have survived since 1995, only 2 of them have outperformed a simple, low-cost S&P 500 index fund. Look, dividends themselves aren't bad. They're just misunderstood. For example, dividends don't create new wealth. They just move your investment dollars from one pocket to another. You see, when a company pays a dividend, its stock price typically drops by the same amount. You might feel richer because you see cash land into your account, but the overall value of your portfolio hasn't changed after the stock price adjusts. And then there's the tax problem. Dividends earned in taxable accounts are taxed every single year, whether you spend them or not. And depending on your tax bracket, that drag can reduce your returns by as much as 1.5% per year. For Mark and Patty, chasing yield would have led to more risk, more taxes, and less flexibility, which is why I encourage them to shift from a high-yield mindset to an intentional income framework, one that aligns their investments with their unique goals. It's commonly referred to as the 3-bucket system, and here's how it works. Think of your portfolio as not just one big pile of money, but as 3 distinct buckets, each built to do a specific job. Bucket number 1 is for short-term stability. This bucket holds 1 to 2 years of living expenses. This is money you know you'll need soon, so it belongs in short-term, stable investments like high-yield savings, CDs, or money market funds. The goal here isn't growth, it's safety. When the stock market drops 30%, This bucket gives you the confidence and flexibility to avoid selling long-term investments at the wrong time. Bucket number 2 is medium-term resilience. This bucket covers expenses that you'll need in 3 to 5 years, and it's invested in high-quality, intermediate-term bonds and TIPS, assets that provide slightly higher returns for taking slightly more risk. Think of this bucket as your bridge, the one that connects your short-term safety net to bucket number 3, your long-term growth engine. Your third bucket fuels the next 30 to 40 years of your retirement, and it's invested in a globally diversified, evidence-based stock portfolio. Large cap and small cap stocks, value stocks, REITs, international and emerging market stocks. The goal is not to swing for the fences, but to create durable, inflation-beating growth that replenishes your other 2 buckets over time. When these 3 buckets work together, you get something powerful: liquidity for today, stability for tomorrow, and growth for decades. Unlike a high-yield strategy, this approach gives you control and clarity even when the markets get chaotic. And because 75% of all large-cap stocks pay a dividend, a properly built portfolio will naturally receive regular dividends. However, yield alone should never drive your investment choices. So here's the takeaway. Give every dollar a job: a safety bucket, a bridge bucket, and a growth bucket. The exact mix will look different for everyone, but the structure stays the same. And for Mark and Patty, assigning every dollar a purpose was just the start. The real challenge came when we tested whether those dollars could actually fund their lifestyle. That test started with one big question: could their 3-bucket plan realistically support the way they wanted to live, especially early in retirement? For them, the target was ambitious. They needed about $10,000 per month to fund their retirement lifestyle in the early years. That covered baseline expenses, but also included costs that would not last forever: a mortgage that eventually gets paid off, heavy travel in their go-go years, and private health insurance until Medicare. Altogether, those temporary expenses added roughly $4,000 per month on top of their baseline spending. Now, let's pause for a moment. If this sounds like your situation, does your plan actually account for how spending changes throughout retirement? Because this is one of the most common mistakes I see. Many people rely on a simple online calculator or a Monte Carlo simulation that assumes a flat spending pattern just adjusted for inflation. But that's not how retirement really works. Spending isn't linear, it's dynamic. It ebbs and flows as your lifestyle shifts, your health changes, and certain costs fall away. Those first 10 to 15 years are especially unpredictable. You travel more, spend more, and often take on temporary expenses that fade later. So, while a Monte Carlo simulation or retirement calculator can highlight big picture trends, it's not enough on its own. A projection only has value if it adapts, if it reflects your real-world spending patterns and gets updated regularly as life evolves. And that brings us to the next question Mark and Patty had to face. Even if their spending plan was realistic, was it actually sustainable? Mark and Patty's retirement goal was not modest. They needed about $10,000 per month or $120,000 per year to fund their lifestyle. On a $2 million portfolio, that's a 6% withdrawal rate, well above the traditional safe 4%. At first glance, that might sound too risky. After all, the 4% rule has been the go-to retirement guideline for decades. But here's the problem. The 4% rule was never designed to tell you how to thrive in retirement. It was built to make sure you didn't run out of money in the absolute worst historical scenarios. In other words, it's a worst-case safety net, and like most safety nets, it sacrifices freedom for protection. When researchers revisited the data, they found something surprising. Retirees who followed the 4% rule were more likely to end their retirement with 5 times their starting nest egg than to have less than what they began with. That's not running out of money. That's underspending for 30 years. So while 6% might look aggressive on paper, 4% might actually be too conservative, especially for people like Mark and Patty who are retiring early and want to fully enjoy their go-go years. And don't forget, a healthy percentage of their expenses are temporary, but they still need to be careful about over-withdrawing in those early years of retirement. To protect their long-term plan and fund the lifestyle they want now, I recommended replacing the rigid and overly conservative 4% rule with a retirement guardrail strategy. Instead of locking into a static withdrawal rate, Guardrails creates a flexible range that adjusts as markets and spending needs evolve. It's dynamic, responsive to real life, not a rigid formula. In addition, by combining guardrails with a well-structured investment portfolio, Mark and Patty can safely start closer to a 6% withdrawal rate, giving them permission to enjoy their early retirement years without putting their future at risk. When markets go strong, guardrails allow them to spend a little more. When markets pull back, it nudges them to scale back temporarily, maybe skip a big trip or delay a purchase. This approach is grounded in academic research and built for the reality of retirement, where flexibility beats perfection. Because the goal isn't to finish life with an oversized nest egg, it's to spend confidently, live fully, and make the most of the years you've worked so hard for. Here's where things get really interesting. We've built a withdrawal strategy that funds their lifestyle, but how that money is pulled from their portfolio determines how much of it they actually keep. Without intentional planning, even well-prepared retirees can end up paying hundreds of thousands more in taxes than necessary, simply because they follow generic withdrawal rules instead of a personalized tax plan. For Mark and Patty, about 60% of their savings sat in pre-tax accounts. So we started our analysis by building a lifetime tax projection, not a one-year estimate, but a forward-looking roadmap that mapped out every phase of retirement. At first glance, the traditional withdrawal order, taxable accounts first, then tax-deferred, then Roth, seemed reasonable. Early on, they could comfortably live off their brokerage account and take advantage of lower capital gains rates. But fast forward 16 years and the picture shifted dramatically. Once required minimum distributions kicked in, their growing IRA balances, combined with Social Security, pushed them into a much higher tax bracket. The impact was staggering, nearly $2 million in lifetime taxes. But with proactive planning, strategically blending withdrawals and conversions, we found a way to cut that tax bill by about $500,000. That's $500,000 they can use now to fund their life, not the IRS. So to avoid overpaying the IRS, we designed a plan to proactively address future taxes before they became a problem. We modeled several Roth conversion strategies, and on paper, the most aggressive version produced impressive long-term results. But it also created massive near-term tax bills, something most retirees aren't eager to face. That's where planning meets real life. Yes, taxes are inevitable when you own pre-tax accounts, but timing is a choice. You decide when to convert and how much. So instead of maxing out aggressive conversions, we proposed a more balanced approach, filling the 12% bracket each year, potentially dipping into the 22% bracket in some years, and leaving flexibility for the future. This approach still cut their lifetime tax bill significantly while preserving room for qualified charitable distributions, QCDs, later in retirement. Those QCDs can offset future RMDs and further reduce taxable income, which was perfect because they were already inclined to give back. Ultimately, true tax planning isn't about squeezing every last dollar out of a spreadsheet. It's about optimizing across real-world goals, income needs, and comfort with taxes, so your plan works not just mathematically, but emotionally and practically too. I've spoken with retirees in their 70s and 80s who've built significant wealth, and almost every one of them has shared the same regret. They wish they had planned for taxes sooner. And to be extra clear, good tax planning isn't about paying less for the sake of it. It's about creating more net income, more flexibility, and more freedom in how you live. By the end of this process, Mark and Patty finally knew, with clarity and confidence, that they could retire early and live the life they envisioned. They had a plan that didn't just look good on paper, it worked in real life. A plan that prepared them for the inevitable: market pullbacks, inflation, rising healthcare costs, longevity, and still gave them permission to enjoy today. They found their Roth conversion sweet spot so they could pay taxes on their terms instead of the government's. They optimized for their charitable goals through future QCDs. And most importantly, they built a retirement structure that let them step away and think freely about their next chapter. For them, that meant traveling more, giving more, and finally having the space to slow down. And that's when it hit them. It wasn't just one smart decision that got them here. It was how all the pieces, taxes, income, investments, and timing work together. And that's exactly why we created the Total Retirement System, to help people like Mark and Patty make every piece of their plan work together. Because retirement success isn't about luck or solving one problem at a time in isolation. It's about coordination, getting all the moving parts of your financial life working toward the same goal. Here's how the total retirement system works. Step 1 is tax planning. We start here because every retirement decision flows through your tax return. By understanding tax rules and proactively planning for RMDs, Medicare premiums, and future changes, we keep more money in your pocket. Step 2 is retirement income. This is where we address the withdrawal trap. Using our Guardrail strategy, we design an income plan that adapts with market conditions, so you can enjoy more in your active years without risking painful cutbacks later. Step 3 is legacy planning. We integrate insurance and estate strategies so your wealth supports your family and your goals, not unexpected expenses. Finally, step 4 is investments. With taxes, income, and legacy as the blueprint, we build a retirement portfolio designed for balance, inflation protection, and tax efficiency. What makes this system different is that these steps don't work in isolation. They work together. That coordination is what transforms uncertainty into confidence. Now that you know exactly how to turn $2 million in your late 50s into lifetime income you can't outlive and the exact steps to make it happen, you don't have to wonder if you're truly ready for retirement. But understanding and implementing it are two very different things. The difference between a good plan and a great one is personalization, knowing exactly how to fit these steps around your goals, your tax picture, and your timeline. So if you want help building that personalized version of this strategy, click the link below to schedule a free retirement strategy session. We'll walk through your plan, stress test your numbers, and show you how to create an integrated income system that supports the life you actually want to live, not just the one your spreadsheets predict. Thanks so much for watching. I'll see you in the next video.